Decentralized prediction markets have been generating a lot of buzz lately, especially with the US elections coming up soon and trading volumes hitting hundreds of millions. So we're going to dive into what these markets are all about, highlighting the most popular projects in the space and exploring their impact. Simply put, prediction markets are platforms where people can bet on the outcome of future events. Imagine a stock market, but instead of trading shares in companies, participants trade shares in possible outcomes of specific events. These events can range from political elections and sports matches to the future price of commodities or even the weather. Prediction markets have been around for centuries. Now, with the rise of blockchain technology, as early as 2016, decentralized prediction markets projects like Augur and Gnosis emerged. Augur quickly became popular after its official launch in 2018. However, it faced several challenges. For one, it was notoriously difficult to use with a clunky interface and slow transaction times. On top of that, without any regulation, controversial markets like assassination markets appeared. These are markets where people could place wagers on the date of someone's death, which obviously raised ethical concerns. As time went on, the buzz around Augur faded, along with the overall interest in decentralized prediction markets. But this year, the space came back to life like never before. So why did it resurge? Well, it could be for a couple of reasons. First of all, 2024 is packed with major global events. We got the Olympics, the US presidential election, and other significant elections around the world, which naturally spark interest in prediction markets. Plus, newer platforms have made improvements in user experience, focusing on more intuitive interfaces and smoother interactions, making them more appealing to a broader audience. So how do they actually work? Well, a prediction market is set up around a specific future event, like who will win the next presidential election, or will it rain tomorrow? The market lists all possible outcomes, and participants start trading shares in these outcomes. For example, if you think a particular candidate will win an election, you can buy shares in that outcome. Each share has a maximum value of $1, which represents a 100% probability of the event occurring. So, a share for candidate X wins is currently priced at 0.70 or 70 cents. Now, if new information comes out, like a favorable poll for candidate X, the price might rise to 80 cents, reflecting increased confidence in that outcome. Now, of course, on the flip side, if a scandal breaks out casting doubt on candidate X's chances, the price might drop to 50 cents, indicating a 50% probability of them being elected according to the bettors. There are two main strategies which users can use to profit from these markets. First is by aiming to buy shares at a lower price and sell them at a higher price if the event becomes more likely, or the other way is to hold on to the shares until the final payout. The final payout happens after the event concludes. If you bought a share for 70 cents and it turns out to be the winning outcome, that share is now worth $1, netting you a 30-cent profit per share. This is how Polymarket operates, one of the most popular prediction market platforms. The platform has been around since 2020, and while it did generate some buzz before 2024, the engagement we're seeing now is on another level, having surpassed 1 billion in trading volume in 2024, with nearly half of that driven by the US presidential election. Besides politics, Polymarket offers a variety of markets and events, ranging from sports to even pop culture, essentially anything that's capturing the public's attention. To get started, you log in by connecting a wallet compatible with the Polygon network. Once connected, you can buy shares using USDC, and in exchange, you'll receive outcome tokens for the specific events that you're interested in. These tokens represent your stake in the outcome you believe will happen. You can trade these shares before the event concludes, which means you can take profit or cut your losses short as the market sentiment shifts. In the background, liquidity providers play a crucial role. They supply supply USDC, which ensures that users can buy and sell shares smoothly without significant delays or price fluctuations. These liquidity providers earn a portion of the trading fees as an incentive. Now, like I said, each bet is concluded based on the actual outcome. So shares of the correct outcome can be redeemed for 1 USDC, while shares in the incorrect outcome become worthless. Since Polymarket runs on the blockchain and operates using smart contracts, it relies on an oracle to resolve markets based on real-world events. In this case, Polymarket uses an oracle provided by Universal Market Access. UMA's system involves proposers who submit what they believe is the correct outcome for an event on Polymarket. To make a submission, proposers must also put up a financial bond as collateral, demonstrating their confidence in the accuracy of their submission. Once proposers submit an outcome to UMA's oracle, there is a 2-hour dispute period during which others can challenge the proposed outcome if they believe that it's incorrect. If no one disputes it, the outcome is accepted as final. But if it is disputed, the case will be escalated and there will be a vote by UMA's token holders to decide the final outcome. So why are people so interested in prediction markets anyway? Well, one of the biggest strengths of prediction markets is how they harness the collective wisdom of the crowd. As more people bet on different outcomes, the market reflects this collective insight in real time, adjusting as new information comes in. Plus, participants in these markets are financially motivated to be accurate. If they predict correctly, they profit. This incentive structure encourages people to think carefully about their bets, leading to more informed and thoughtful predictions. However, prediction markets aren't without their drawbacks. For one, they measure public opinion, which doesn't always align with predicting the most likely outcome. Sometimes markets can be swayed by factors like hype or misinformation. For example, during highly emotional or polarizing events, such as political elections, participants might bet based on their subjective biases rather than objective analysis. And this can lead to skewed results where the market reflects popular sentiment rather than a realistic outcome. Vitalik himself has always been intrigued with prediction markets and their application in blockchain technology and has talked about it multiple times in his blog posts, but we'll have to get into those in a future video. So if you agree with him, then these prediction markets may offer immense potential despite some of the challenges that they face. Have you used any blockchain-based prediction markets? Well, let us know in the comments below.